Today I'm going to show you the real, most valuable insights about trading with supply and demand in a way that's not taught anywhere else. And once again, I guarantee you that this video will create in you powerful breakthroughs that will change your bottom line results in trading. The bottom line is you will be able to get more winning trades and increase your account. So let's get started doing exactly that right now. So as you watch this video and you have the breakthroughs that you're about to have, just smash the like button and let me know that you appreciate learning this level of trading knowledge for free. If we start with the concept of supply and demand, in trading it simply means that if the price goes up, it's because there is demand. And if it goes down, it's because there is excess supply relative to the demand. You can watch a chart and just see, even if one candle is going up, it's because there's an increase in demand. And if it goes down, it's because there's excess supply. Okay, so that's true, and that's nice to know. Does knowing that enable you to know when the market is turning and how long it will go in one direction? It totally does not, but there are other visual and technical things that do show this. Here is something that you would think would be fundamental in trading. How can you tell if the market will retrace and then continue to move in the same direction versus how can you tell when it will actually reverse completely? And then after the market does make some kind of a turn on some time frame, how will you know when it will go the other direction? Basically, how can you know when you would get in and when you would get out of a trade? How can you know when to buy and sell other than just guessing and flipping a coin and trying to increase your probability a little bit? Can you actually know when the market is turning? Can you see when the market is turning? Well, knowing that because when the market goes up, it's because of an increase in demand, and when it goes down, it's because of an increase in supply, that doesn't tell you anything about when and why it would turn. So when it comes to the supposed supply and demand trading, is it based on the probability that turning at previous supply and demand is something that would give you a higher probability? Although many experts claim that supply and demand is nothing like support and resistance, apparently this is because advocating that particular term as a brand name for a type of trading gives some additional kind of authority, which is only a very slight improvement over what has always been known as support and resistance. And you can call it one term or you can call it another. How much does it help you to be able to trade and make money? Here's one very important insight that I have discovered to be true. And that is that by applying the understanding that when markets move, it's because of supply and demand, and also using terminology like institutional traders, retail traders, order flow, bankers, there is a presupposed assumption that the trading method called supply and demand trading would give some special ability to be able to know the places where the market is turning and would impart some special ability to trade with the institutional traders. Well, when you see the actual method that's called supply and demand trading, it doesn't take long to realize how completely clueless the experts are in the ability to simply identify a regular turning point in the market. If using this knowledge doesn't impart some special ability to know when the market is going to turn, and so identifying these turning points is not possible, and it comes down to so much blind uncertainty and lacking in any confident knowing of high probability, can we even say that using this trading method and using these zones is actually having anything to do with identifying true supply and demand? How do you know when there's a change in the current supply or demand of a certain currency pair or other financial equity? Let me show you what true supply and demand trading is all about. The way that I have always traded is based on true supply and demand. And you can see when I'm trading that I don't even have these zones drawn on my charts. Now, you can draw these zones on your charts, and it might help somewhat, but that is not how you tell when there is a change in supply and demand. The probability that I identify the actual turning points right on the dot is much higher than any trader using the supply and demand trading method. And I am willing to test that out with any trader using the supply and demand trading method. Would you like to test that out? You can test it for yourself, and I'll show you how right now. Here is the real scientific truth and what I have discovered from years of research and observation of market behavior. What's kind of critical is that there are a few steps to make these known and recognized visual criteria visible on the chart. For a lot of people, you can't see them because the charts are not adjusted properly. There is critical visual information that you just may not be able to see because your charts are not adjusted properly and you don't know what it is that you should be paying attention to. Most people don't know how to see it, and a lot of people don't believe that it's possible to see it, so then they're not looking. One thing for sure, these turns, the actual turning points, they may or may not be at previous supply and demand zones. That can have a little bit of relevance to where a turning point can happen, but as you will see right on the charts, you can test for yourself right now today, the real turning points often normally happen at places that aren't previous supply and demand zones. Would you like to see just how true this is and be able to trade based on what you know to be true? For me, I'm paying very little attention to these zones from the past, but I know that I can identify the true actual supply and demand turning points, and to be able to do it with a high degree of accuracy and probability. And because it is a visual thing, often it's just very obvious. These are the actual real turning points, and they can be identified in advance before they happen and in real time as they happen. And it all can be done just visually, sometimes very easily, and sometimes with the assistance of a few additional steps. Okay, so you can see that sometimes the market does turn at previous supply and demand zones. And that may be able to help you to see some of these areas and have a little bit more probability. But it should be known that that is not how you determine these turning points. Now, the way for you to see that this is true is to look at a chart. That's how I know it's true. Okay, so here is a trend. The funny thing is, we can take any chart on any time frame for any currency pair, and we can take that chart and then we can identify where is the trend and where are the corrections. Besides that, there is a known, recognized shape that a trend makes. And here's where a lot of people made the mistake that it has something to do with counting something. It doesn't have much to do with counting things. It has to do with recognizing a known shape. So that's how you recognize a trend. Now you could say an uptrend is made up of higher highs and higher lows and waves that don't overlap. A correction in a downtrend is made up of higher highs and higher lows and waves that do overlap. There's a little bit more to it than just that. In fact, if you're involved in trading financial markets, it ought to become really clear and obvious on the first day if you're guided with any kind of useful knowledge that here's how you look at a chart. You see the part that's the trend, and you see the part that's the correction. You can distinguish the difference. These are two completely different psychological and supply and demand behaviors of the market. Like I have said before in one of my previous videos, when there is a trend, the market will just go right through all supply and demand. It's not going to stop. And when there is a correction, these corrections come back to a place that's nowhere near previous support and resistance, meaning much of the time. This point, that's the end of the correction. It is a known shape. All you got to do is look at it. Anybody who has any experience with looking at charts go, oh, that's a correction. It is a known shape, and it goes to a place that's not supply and demand. This goes to a place that's not supply and demand. Maybe it might go to a place that is at supply and demand. That's nice, but that's not how you tell if it's a trend or a correction, if there is a change in supply and demand. Just like a horse has a certain shape, you can look at it and say, hey, that's a horse. Or a table has a certain shape, you can just look at it and say, that's a table. And a trend has a certain shape, you can look at it and recognize that it's a trend. This is a correction to a trend, and it's a different type of price action. Don't want to get too far ahead of myself, but during a correction on a shorter time frame, there will be trends going down on a shorter time frame. These corrections have clear, identifiable shapes, and it can be recognized a lot of times very easily when there's an end of a correction. So interestingly, there could be people in the world who would say things about trading denying that this formed, and that's not very scientific. I've done some testing and I've discovered that these trends do form on the charts of everyone. So some people think that they only form on charts of people who believe in Elliott wave. Well, actually they form on all charts. You just have to adjust your charts, get on the appropriate time frame, and the appropriate currency pair, and see them. Many times there are intelligent, educated people who have some authority, such as, I've been trading professionally for 40 years, and that Elliott wave stuff doesn't work. But when I hear that, I'm always just very glad and thankful and gratified, because in a way what it's saying is that I must have some kind of a superhuman skill because I know that it works. So if some educated, intelligent person with authority tells me that it doesn't work, then that just means that this skill is extremely desirable. It's extremely rare. It's as if it's some kind of a superhuman skill, but the truth is, it seems to me like it's kind of obvious, and I think that I could show anybody how to identify the end of a trend and how to identify the end of a correction, which is extremely valuable to know. When your intention is trading, you want to know, when can I get into a trade and when can I get out of a trade? And so here is where we really need to take a good look at the market and discover what is true. What is true about this market? What's the scientific truth about what this financial market is doing? I can tell you what it's doing is forming known, recognizable trends, and then it's forming known, recognizable corrections. And that is what it's doing. So if we know that most people cannot trade, they can't tell when there's an end of a trend or an end of a correction, they don't know what a turning point is, no matter how professional they are, then logically speaking, it would make sense that most people would probably disagree with the way that I'm trading and getting the results. But to see, the thing is, what's proving what the market does is, first of all, when you see it and you know that it's true, and second of all, when you enter a trade, you get profit, and you do that over and over again, you go, oh, okay, so that's true. And it doesn't matter who says it's not true, right? Who cares? So the more people who feel the need to tell me, like someone feels the need, they're going to tell me that this doesn't work, then that just makes it so much better for me, because I have more gratitude, more thankfulness, and I can just really appreciate the fact that I can see this and do this. And I think that everyone else can do it too, if you just had a little bit of guidance and you knew what it was that you're supposed to be looking for. So the key here is that if you can see the end of a trend and recognize it, and if you can see the end of a correction and recognize it, then that's the real key to true supply and demand. If there is an uptrend, the end of the trend is supply. It's not some place in the past that you may have marked where the market may have turned in the past. It's the end of the trend, that's supply. If there's an uptrend and it forms a correction, the end of the correction is demand. That's an absolute fact. And you can see it. In a downtrend, the end of a downtrend is demand. That's the actual point where the market shifts into a state that is predominantly based on demand. And then when there's a correction in a downtrend, the actual end of the correction is supply. Absolutely no question about it. The end of the correction in a downtrend is supply, not someplace in the past that you may have marked. Now we're going to show you more about this, and you're going to be able to see for yourself just how true this is. Now, what's even more important is when you see the pattern that the market made, it made that. You can't say that it didn't make that and be sane. The market made that. And the reason that it made that is because institutional traders created that. And you can see it and recognize it. That's why some economic experts will say that that is just the footprint of the market. To try to relegate it to being something that is not as good or not as effective as knowing why economically these things happen. If you have ever dealt with or learned from economic experts, you can see that they can take all the information that there is in the whole world. You can subscribe to Bloomberg terminals and news feeds and stuff and try to keep track of all this economic stuff. You will never have the same degree of effectiveness that a person who knows how to read charts can tell just by looking at it. There will be times when there will be a pattern that could complete possibly one way or another, and maybe you can apply knowing something about economics or news to know the most likely direction that something's going to go at a certain time. But seeing it on the chart is showing you very accurately what the market is doing. If you know what it means and you know how to read it, and you see that these things keep happening over and over again, and that the market just does nothing but different variations of the same patterns that it has always made. So in supply and demand, sometimes you will notice that people are using terms like institutional traders, retail traders, buying and selling and order flow, and focusing on these things instead of just focusing on the pattern, the direction that the market is making. And there is this implication that if your identity is a retail trader, what does that mean? I mean, anybody who opens an account and starts trading, your identity is going to be a retail trader. But if you believe that your identity makes you powerless to understand the real reasons why the institutional traders are doing what they're doing, if you believe that you're powerless, that's not really going to help you in your trading. The truth is, whether you have $100 in your account or whether you have $1 million in your account, if you can see this pattern, you can enter a trade and get profit from it. So try this out for yourself. Get the top economic expert that you know to show you the next trade. And then get someone who knows how to read charts show you the next trade. What's the result? And while you're at it, you can get someone who knows supply and demand trading method and get them to show you the next trade. It's going to be pretty much a flip of a coin. Okay, so here's the next thing that I want to cover in the subject of supply and demand trading. A lot of times in supply and demand trading, they're going to show you a chart that looks a lot like this. So when I have my chart, whatever time frame it's on, and I'm zoomed in to see these great big boxes on here, I actually can't see any real price action because the price action is forming these shapes and patterns. Now I can't see them, but they will go to a certain time frame. And it really doesn't matter what the time frame is, but if they focus on the daily, and they may be looking to enter it on a shorter time frame and exit it, but if they're focusing on the daily, and you have one or two bearish candles in an uptrend, and then what they're going to do is they're going to draw these lines and show you that, well, it's a zone. So what we're going to do is we're going to draw it from the high of this bearish candle into the low of the body of the candle. And pretend like that's doing something or that has some significance. So the truth is, if you're looking at this time frame, there's a correction here and you can't see it because it's inside of that candle. And especially if you have one bearish candle in an uptrend, and if you have charts that are adjusted to display an uptrend with just one bearish candle in an uptrend, and then you're drawing these lines for supply and demand zones based on one bearish candle, and you can't see the correction. Why can you not see it? It's there on a shorter time frame. Why is it? Because you are powerless. You can't go to a shorter time frame. That's why you can't see it. That's also why they have the term hidden supply, hidden demand. It's hidden because it's on a different time frame. Why is it hidden? Because you are powerless. You can't look at another time frame. All you have to do is just go to another time frame. If I'm on the daily and I see one bearish candle, I probably need to examine that candle on the 4-hour or the 1-hour. So here I am on the 4-hour, and now I can see a perfect shape of a trend and an almost perfect shape of a correction. I can take it on down to the 2-hour, and now I see this correction. But if I stayed on the time frame where that was just one candle, I wouldn't see a correction. Why do you think that a trader would want to make sure that they don't see and that you don't see a correction? Why do you think they would want you to not see a correction? So every trend that's displayed that has inside of a trend one bearish candle or something like that, even on these shorter time frames, there'll be subdivisions, there'll be trends, there'll be corrections, and there will be candles here. Maybe if I go to a shorter time frame, I could see more detail of that correction. That's the way the market is. So this is one key thing about the right way to use supply and demand in trading, is that if you take any trend and inside of that trend you have one or two bearish candles in an uptrend, or one or two bullish candles in a downtrend, the first thing you would need to know is that there's a correction there and that you can't see it. And the way to see it would be to go to a shorter time frame. Most of you who know about my training and the type of trading that I do myself and advocate is that I focus a lot on longer and medium time frames. And what I'm not doing is going to shorter time frames and scalping the market, but I do like to be able to read charts, and for whatever time frame you're on, if you're looking at something and there's one or two bearish candles there, and if you wanted to know anything about the market, you would go to a shorter time frame where you could see it. So wouldn't that make sense that if you wanted to see a correction, you could go to a shorter time frame and then you could see it? And then you wouldn't have to resort to this idea of taking this one candle and drawing a zone from the wick of the candle to the body of the candle on the other side, and blah, 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 as if that had some kind of a meaning and that there was some kind of a significance to supply and demand traders doing that, which there isn't. So the reason that you're being told to not go to a shorter time frame and see a correction is because supply and demand traders don't know what a correction is or what it looks like or how to tell the end of a correction. So that's going to be kind of a disadvantage if you choose to do that. If you choose to do that, you're going to be kind of at a visual disadvantage. Here's one of the next things that you should notice if you've ever had any exposure to the so-called supply and demand trading method. Supply and demand trading method experts will always take pieces of the market that look like this and talk about the supply and demand of this movement and call this an uptrend. That right there is a huge mistake, because if you don't even know the difference between the type of price action of an uptrend versus a correction, which is going up, in a downtrend, they're completely different types of price action with a different type of pattern. So I have seen many of these price action trading experts showing all of their examples talking about an uptrend when it's not an uptrend. So one of the first things that you should learn about financial markets is about this concept of having trends that form impulsive movement and corrections that form corrective movement. And sometimes you will hear in the field of Elliott wave that an uptrend is a series of higher highs and higher lows and waves that don't overlap. Like this would be an uptrend. Not only do they not overlap, it's just a completely different type of shape and a completely different type of price action. During an uptrend, the market will move a great amount of price over a short period of time. And what does that do? It changes the angle of the movement so that after a trend, the angle of the movement is shallow and not as steep, meaning that it takes a longer period of time to move only a percentage of the price that it moved during the trend. So that once you know this, you'll be able to see trends and corrections everywhere, whether they're overlapping or not. If it went up and formed a trend, but then it formed a correction over a longer period of time and only went a percentage, then you can recognize that that's a correction. And this will help you to be able to put together all the pieces that the market is forming and look at charts and know there's trends, there's correction. Here's a point where a trend started. Here's a point where a trend ended. Here's the start of a correction. Here's the ending of a correction. If you don't know those things, well, it would be pretty difficult trading, yes. And that's really the whole skill of how anyone would be able to trade. So that's why so many people can't trade, is because they don't know that. Now, I've also heard supply and demand experts talk about two different types of markets. One would be a trending market, and one would be a ranging market. Well, this is a great oversimplification of the real types of price action, type of market conditions that the market actually makes. If the market is ranging, that's a certain type of correction. It's just going sideways, and that is a correction. It's a certain type of a correction. In a normal type of correction, a trend will end like this one ended here, and then a correction starts. There's no overlapping waves. There's just three waves. And inside of those waves, there are big trends going down. If you don't know this to be true, how would you ever even consider why would you enter a trade if you don't know that there are corrections, and how could you identify the end of a correction? Now, if you do notice the places where the market turned in the past and you want to draw lines or zones where the market has turned in the past, and maybe you could use that because sometimes the market does turn at previous support or resistance. But as I've shown many times before, if you take any correction, like this is a wave 3 and that's a trend right there, then that's a correction to that trend. It will always be turning, usually at a place that's not previous support. And then for every correction, A, B, C, in the opposite direction of the trend, it will turn at a place that's not previous support every single time. Here's a trend, here's a correction, turning in the middle of a big wave that's going down. It always does that, if you ever notice that. So the thing that you want to notice is that during every trend, all support and resistance will be ignored. And then during a correction, it will also ignore support and resistance. There are some turning points that happen to be at previous support and resistance. That's not the main thing. And it certainly isn't the way to tell how to trade or where the market is turning. Okay, so here's the next challenge that you will find in using what's known as the supply and demand trading method, and that is what I call the projection of imagined intentions. Imagined intentions that support limiting core beliefs. And this is a real thing, and it really affects the way that people trade. So let me show you what it is that I'm talking about. When you look at the market, it's just price, it's just going up and down. And as long as we just see that as a natural process, and that is neither good nor bad. And the intentions of traders on the other side of the market, we don't know their personal intentions. All the movements are caused by the collective intentions of all the people trading, and anyone who represents institutional traders. If what they are doing is getting profit, then the intentions are to get profit, and that's good. But notice when people talk about this type of trading, they're using this terminology and they are imagining and projecting moral intentions on the other traders. The actual core beliefs that are taught and accepted in this type of trading are limiting core beliefs such as rich people are bad and making money is bad. When you look at a chart and you say, see that point right there? That's where institutional traders were grabbing the profit away from those poor little retail traders. The poor retail, they're trying to make money, but the institutional traders aren't letting them because they don't care about anyone but themselves. They just want to steal that money away from the retail traders. That's all just happening in the minds of people. What's really happening is the market just going up and down, and it's neither good nor bad. So if a trader does project imagined intentions onto some imagined person who's on the other side of the market, notice how that justifies that trader's core beliefs about limiting core beliefs such as rich people are bad or making money is bad. And then notice that you want to become rich and you want to make money, but there seems to be some kind of a conflict with that. When you look at a chart, it's just price going up or down. Notice the euro against the dollar is going up, the dollar is going down. What if you turn it around or you looked at the US dollar Swiss instead? It would be going the opposite direction. Neither one of them is good or bad. And the intentions of the people who are trading and trading successfully is not bad. Notice that there are many people who are looking at a chart and then they're going to say, here's where that evil, selfish banker bought and destroyed the trades of retail traders. And they're helpless. Those poor retail traders, they want to make some money, but these selfish institutional traders are grabbing that profit away from the retail traders. Whether you believe it or not, I'm telling you right now, this is why traders can't trade. Because they believe, first of all, that if you're doing what institutional traders are doing, you're doing something morally wrong. Then you want to be like the institutional trader. You want to do what's causing you to get profit, but that's bad. And also, making money is bad. So you have a conflict, and the conflict is your core belief. Let me tell you, you have to change your limiting core beliefs, and you can't do it by thinking about it. You can't do it by reading a book or something like that. There are certain ways that you can change your beliefs so that you don't have that belief, and then you can just relax and feel in harmony and see a market going up and down. There's nobody out there doing a bad, evil thing. While the market's going up and down, you can get in and get out and get profit, and there's nothing bad about it. But if you believe that there's something bad about it, you will have an inner conflict which causes self-sabotage, which is an unconscious process. You won't ever know what's actually happening. This type of analysis, which is personifying impersonal forces, where the market is going up and down, but they're personifying it and saying, here's that banker, and that banker is bad. That is a type of analysis that any trader who wants to get good results needs to get rid of, and they need to have a more sane approach to trading where you're not imagining these things that don't exist, and you're just seeing the market just going up and down. You can choose to get in and choose to get out whenever you want. You can do just what any institutional trader is doing because you can see the pattern of what it is that they're doing. You can make as much money as you want, and there's nothing to stop you if you believe that. The market goes up and down. It goes up because of an increase in demand, and it goes down because of an increase in supply. And both of those movements are wonderful. They both produce excellent opportunities for us to get profit. And whoever the people are who are causing this thing to go up and down, who knows? But we're not going to project any moral intentions on the people who are causing the market to go up and down. We're not going to imagine all these things like there's some evil banker out there doing a bad thing. Then we want to be just like them, and they're making money and we want to make money, but then we have this conflict and we think it's bad. So instead of doing that, I can tell you right now, what you probably want to do is to learn to reprogram your subconscious beliefs. And I need to say this, even though this is not a technical aspect of actually how you use supply and demand, looking at charts and be able to do this process, but it is very important. So if you did find this useful, just imagine how much more you can learn if you're interested in really applying yourself, especially applying yourself in the live market, such as during our live trading sessions. Well, if you'd like to learn more, just go to our website at tradingmastermind.com, and we do have a free professional trading course. And this is what I send out to people to help them to get started in trading. This course includes over 40 different videos that demonstrate a lot of what I'm talking about right now, of how you can trade and how you can be successful at trading. Now, I've made another series of videos about this topic, and you can watch those right over here.